and welcome to Money Myths Episode 1. What is money? My name is Brian Leslie and I'm the editor of Sustainable Economics magazine. Before we get started, I've a couple of things to mention. Although I'm referring to the British banking system for this series, the system in most countries is the same and has similar history. I leave it up to you to substitute your own central bank, government, ruler and so on. OK, so on with part 1. What is money? In brief, it's anything generally accepted within a group as a means of exchange. Some things that have been used as money have value of their own, such as gold or silver. This is known as its intrinsic value. Other things used as money, such as paper or shells, have little or no value in themselves. Either way, they're accepted as tokens to be used for the purchase of goods or services. Another form of money in Britain for many centuries was the use of tally sticks as receipts for large value taxes. These were sticks of hazel, notched in a way to indicate their value. They were then split along their length, and the taxman kept one half, while the other formed the receipt, which then could be used as money. This system only finally ended in the 19th century, when a fire being used to dispose of them got out of hand and burnt down the Houses of Parliament. So how is money created? Most people think that money is just the notes and coins in their pockets, and that it's created by the government and spent into circulation. Well, some of it is. In the 1940s, about 40% of the money in circulation was in the form of government-issued notes and coins. It's now only about 3%. Why is this? In the Middle Ages, merchants would put their spare gold into the safekeeping of the goldsmiths, who had secure vaults. They were given paper receipts for the gold. The merchants soon realised that instead of having to go to the goldsmiths to take out some gold to use for payments, they could pass on the receipts instead. This was how our paper money started. The goldsmiths also loaned gold from their vaults. They charged interest on the loans. However, they could only lend out actual gold from the supply they had in their vaults. The greedy goldsmiths realised that they could make loans in the form of the paper receipts that were being used as gold. They then realised that most of the gold in their vaults was never taken out by the depositors. So they started issuing receipts for much more gold than they actually had. As long as no one found out, then there wouldn't be a problem. This increased the money supply, and as long as they were not too greedy, they wouldn't be found out. So began the modern system called fractional reserve banking. The interest they charged on the loans eventually proved more profitable for them, for some of them, than their work as goldsmiths, and they'd become the first modern bankers. Gradually, the new banks took over the task of money creation from the rulers, kings, governments, etc., by issuing their own banknotes. This practice went on until it was outlawed in Britain in the 19th century. The Bank of England, which was still a private bank, had special privileges granted to it, along with special responsibilities, and it was the only bank then allowed to issue banknotes. As the other banks could no longer print their own banknotes, and therefore couldn't make profits from loaning them out, they started encouraging the use of cheques, and more recently, credit or debit cards and electronic transfers. This allowed them to continue to create money by making loans. As already noted, by the 1940s, after the Bank of England had at last been nationalised, about 40% of the money supply was still in the form of Bank of England issued notes and coins. This has now dwindled to only about 3%. When a bank makes a loan, it does two things. First, it credits the borrower's account with the money and records it as a liability of the bank. In other words, the bank has entered into its system the ability for the borrower to go out and spend the value of the loan at some future time. Then it records the loan as an asset owed by the borrower to the bank, again in the future, thereby balancing its books. In addition to the amount of the loan, the borrower has to pay interest. The money loaned doesn't come from any depositor's account. What the bank's done is to create the money it lent out of nothing, or at least out of account entries. It has to keep available enough reserve to meet demands for payments. This limits the extent it can expand the money supply by making loans. For much of the last century, there was a statutory fractional reserve required of around 10%. That means that banks had to keep reserves, made up of notes and coins, and deposits in their own accounts with the Bank of England. The reserves had to equal at least 10% of the amount they had out on loan. In the 1970s, this legal limit was lifted, so reserves have dwindled to much less, and the money supply has mushroomed. Let's look at an example. With a reserve requirement of 10%, Bank 1 starts with assets of £1,000 in its account. It now lends £900 to someone else, so it has £100 reserves and an asset of the £900 owed to it. With the remaining £100 in its reserves and the £900 loan, it still has £1,000 of assets. The borrower then spends the money and it's deposited into another bank, Bank 2. Bank 2 can now lend out £810 of the £900 to someone else and keep the remaining £90 to add to its reserves, the 10% reserve requirement. Again, the borrower spends it and the money goes to Bank 3. This bank now has an asset of £810 and can lend £729 to someone else, and so on. This can continue with ever-decreasing amounts until eventually the original £1,000 has allowed the banks between them to create another £9,000. The banks are charging interest on all of this new money. This has expanded the money supply by £9,000. So, the banks create money. The bank lends the money to society. The bank charges interest, just like the goldsmiths did. The money that the bank created is eventually repaid to the bank and is cancelled out of existence. But there still remains a debt to be paid, the interest. Let's think about this for a moment. Let's simplify the numbers and give an example of the underlying problem of the current system. We have 11 people in a closed room. 10 of them have nothing, and the 11th has a bowl of beads. We'll call the 11th person the bank. The bank now lends each person 10 beads for 1 hour and charges 10% interest on the loan. The people in the room are free to sell whatever they have to other people in the room in exchange for beads. An hour passes. Some people have now got the 11 beads they need to repay the bank. This means that others don't. It's obvious that there are not enough beads in the room for everyone to repay the bank, so what can be done? Well, some could declare themselves bankrupt and hand over their assets to the bank. Or some people can take out further loans from the bank. If the bank allows these people to take out other loans, that could boost the economy and allow all of the people to repay their debts from the original round of lending. Of course, anyone who borrowed is now in further trouble. they must repay the loans plus the interest. As you can see, there are never enough beads in the room to repay the bank. This growth of the money supply, along with the even greater growth of debt, is the fundamental cause of the current credit crunch, because of the interest imposed on all this bank-created money. Since the deregulation of the banks in the 1970s, the banks have been able to expand their money creation greatly. They now have only tiny reserves, but huge profits from the interest they make on all the loans. This enriches them and their shareholders at the expense of society. The banking system has always been precarious, and it's now far more so. With such small reserves to call on when customers withdraw their money, it only takes a few bad debts to be written off, or a few people to lose trust in the bank and to withdraw their money, for the bank to run into problems. Once news gets out that a bank is in trouble, others start withdrawing their money and the bank becomes bankrupt. With the ever-growing levels of debt due to the way the banks create our money by making loans, and the growing amount of interest to be paid on those loans, any slowing of economic growth can threaten the whole banking system with collapse as the debts become unrepayable, which is why the authorities are now so desperate. With globalisation and deregulation since the 1970s, the banks have been heavily involved with international trade, and so the credit crunch is affecting the whole world. I'll be dealing with this aspect in a later episode. One last thing I would like to show you is the growth in the level of debt in the UK. The shape of the graph, taken from Michael Rowbottom's book The Grip of Death, is almost identical for the US and many other countries. Although there has, for centuries, been the problem of not enough money to repay all the debts and the interest on them, the problem has been getting rapidly worse since the 1970s. This graph only shows the period from 1963 to 96. Since 1996, the problem has got a lot worse. There are also many other social, economic and environmental problems arising from this system, which I'll talk about in later episodes. In the next episode, I'll be looking at possible solutions to the current situation. So on with part 2. As you'll by now realise, there's growing anger at the way the British and American governments seem to be handing over, at taxpayers' expense, vast sums of money to the very banks and financial institutions that caused the trouble in the first place. What's not made clear is which taxpayers will have to pay for this and how they will be able to pay. This is no surprise. The well-known American economist J.K. Galbraith made perhaps the most appropriate comments about the money system when he wrote in his book Money, Whence It Came, Where It Went in 1975. He said that the study of money, above all other fields in economics, is the one in which complexity is used to disguise truth or to evade truth, not to reveal it. I explained in the last episode the way money is created by the banks, and as Galbraith put it, the process by which banks create money is so simple the mind is repelled. Where something so important is involved, a deeper mystery seems only decent. Nearly all our present money is created by banks by making interest-bearing loans. Politicians and economists are reluctant to admit the possibility of the government itself creating money instead of borrowing it, and paying interest on it. This despite the fact that the government does, even now, still create some of it, the notes and coins. We are told that if the government creates more money, this would cause inflation. That's only true if it creates too much, or if the banks continue to use it to increase their reserves, which then allows them to create even more money, as you saw in episode 1. In the past, far more of our money was created by government and spent into circulation without creating any debt. For most of history, inflation was only very slight. Before we can hope to fix any system, we need to understand what the system is. So, what is the current system? Well, governments need to pay for services. They pay for the schools and hospitals, they give money to local authorities, they pay the military, and so on. The governments collect taxes to cover these expenses, but the amount of tax they get is never enough to cover them. They make up the shortfall by borrowing from banks and individuals. They have to pay interest on the money they borrow. The total of the money borrowed is known as the national debt. The total national debt in the UK is now about £650 billion, and the annual interest on it is over £31 billion. This works out at an average of about £500 a year for each man, woman and child. The government's actions so far have been desperate attempts to stave off the collapse of the banking system, rather than to deal with its primary fault, which has caused the problem due to its underlying instability. In doing this, they're rewarding the very people who created the crisis in the first place, while doing little, if anything, to help the victims. As I explained in episode 1, the banks create both new money and debt when they make loans. Surely this is legalised counterfeiting. The banks have, for years, been encouraging individuals and businesses to borrow more and more, with offers of credit cards, cheap loans, remortgages, HP agreements and so on. Reginald McKenna, chairman of the board of the Midland Bank and former Chancellor of the Exchequer, said, "I am afraid that the ordinary citizen will not like to be told that banks can and do create money. And they who control the credit of the nation direct the policy of governments and hold in the hollow of their hands the destiny of the people. If this process of money creation was banned, without doing anything else, the money supply would collapse, even faster than it's now doing. However, the government could and should compensate for the bank's failure by creating more of its own money as it used to." As Robert Hemphill, one-time credit manager of the Federal Reserve Bank of Atlanta, said, "If all the bank loans were paid, no one could have a bank deposit, and there would not be a dollar of coin or currency in circulation." This is a staggering thought. We are completely dependent on the commercial banks. Someone has to borrow every dollar we have in circulation, cash or credit. If the banks create ample synthetic money, we're prosperous. If not, we starve. We are absolutely without a permanent money supply. When one gets a complete grasp of the picture, the tragic absurdity of our hopeless situation is almost incredible. But there it is. The government should itself create and spend the money not to prop up the banks, but on socially valuable things, such as building new schools, hospitals and public transport systems, and fixing the ones we have. It could also be spent on providing solutions to many of the other problems we face, such as tackling the dependence on oil by funding the development of renewable energy and the insulation of all homes and offices. All of these measures would create employment and lead to a better future for all of us. Banks do serve a useful purpose in handling people's accounts, transferring money between them and taking in or paying out notes and coins. They should also be able to lend out the money that is deposited with them by savers. However, they should not be able to lend more than they have in existing assets. This would be the end of fractional reserve banking. We use notes and coins far less these days because it's so much easier to use account entry money. That is, credit or debit cards, cheques, standing orders, direct debits and so on. These are all ways of using money without using notes and coins. It's no use the government just creating loads of new notes and coins. There is, however, no reason why the Bank of England can't create account entry money just as banks do, but then credit it to the government to be spent into circulation rather than lent. The money the government spends would prop up the failing economy and help the surviving banks to get the money back that they've already lent out. The Bank of England is guided by a Monetary Policy Committee, whose job it is to advise the bank on adjustments to the base lending rate of interest. The base rate is the interest rate that the Bank of England charges the commercial banks for their borrowings from it. The bank increases the rate to limit inflation and decreases the rate to encourage borrowing. If you remember from episode 1, banks have to keep a reserve. If they have to hold a bigger reserve, this limits the amount they can lend. If the reserve is allowed to be small, they can lend more. This is the fractional reserve ratio. Instead of using the base lending rate as the control, the Bank of England should be adjusting the fractional reserve ratio, which should again be made a legal requirement. This would limit how much the banks could expand the money supply. The committee, which should be a totally independent body, would advise the Bank of England on how much account entry money to create and to pass to the government, for it to spend into circulation. By this method, the Bank of England would be able to maintain the amount of money in circulation needed by society. We need to end the bank's privilege of money creation. The debts they create by this process seriously distort the economy and the distribution of wealth. So, in summary, the things that ultimately need to happen are: 1. The government needs to remove the ability of the banks to create money. 2. There needs to be an independent, publicly accountable body set up to oversee the creation and possible removal of money from the system to ensure that there is enough money but not too much money in circulation. 3. A mechanism is needed to oversee the transition from the current system. How to make this changeover will be the subject of the next episode. I'll leave you with one final quote from Sir Josiah Stamp, who was a director of the Bank of England from 1928 to 1941. He said, "The modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand that was ever invented. Banking was conceived in iniquity and born in sin. Bankers own the earth. Take it away from them, but leave them the power to create money, and with the flick of a pen, they'll create enough money to buy it back again. Take this great power away from them, and all great fortunes like mine will disappear, and they ought to disappear, for then this would be a better and happier world to live in. But if you want to continue to be slaves of the banks and pay the cost of your own slavery, then let bankers continue to create money and control credit. Sir Josiah was reputed to be the second richest man in Britain at the time. Welcome to Money Myths, Episode 3, Roadmap for Change. So on with Part 3. First, an update. I noted in the last episode that the total national debt in the UK is now about £650 billion. That is, 650 followed by 9 zeros. Since then, the government's announced efforts to cope with the growing depression are forecast to increase it within a year or two to over £1 trillion. That is, 1 followed by 12 zeros. As I said in the last episode, 3 things are needed to resolve the credit crunch and cure the system. 1. The government, ultimately, needs to remove the ability of the banks to create money. 2. There needs to be an independent, publicly accountable body set up to oversee the creation and possible removal of money from the system to ensure that there's enough, but not too much, money in circulation. 3. A mechanism is needed to oversee the transition from the current system. On the first point, it's worth noting that this idea is far from new. For instance, in 1935, a prominent American economist, Irving Fisher, wrote a book called 100% Money. He ended his conclusion with, "If our bankers wish to retain the strictly banking function, loaning, which they can perform better than the government, they should be ready to give back the strictly monetary function, creation of money, which they cannot perform as well as the government." I outlined in the last episode how the government used to limit banks' power to expand the money supply by legally imposing and enforcing a fractional reserve ratio on their lending powers, instead of using the base rate of interest. It's worth pointing out here the fallacy behind the theory that raising interest rates will reduce inflation. What in fact happens is that when interest rates are raised, this at first deters borrowing and so slows the economy, as less money is circulating and desperate sellers cut their margins to boost sales. This does temporarily reduce inflation by lowering prices at the cost of redundancies, growing unemployment and failing businesses, which then causes the government to again reduce interest rates to boost spending. Of course, high interest rates always benefit the lenders, the banks and the rich. Meanwhile, the higher interest charges increase costs, so as soon as they can, firms start to raise their prices as far as they can to recover their lost income. In other words, in the long run, these higher interest charges have increased inflation, which was not the aim. This is reason enough to return to the alternative way to restrict banks' power of money creation, by imposing and adjusting the reserve requirement. One way to get to the final result of ending this power of the banks to create our money is to keep on raising the reserve required over a period, while at the same time compensating for the reducing amount of bank credit in circulation. This must be done by the government itself creating money and spending it into circulation as the bank's reserve is raised, until the banks can no longer create any money, and so can only lend money that is already in existence. Doing it this way could give time for adjustments to be made, and for developing new ways of determining just how much money is needed in the country. The task of deciding how much money is needed should be given to an independent, publicly accountable body set up to oversee the creation and possible removal of money from the system to ensure that there is enough but not too much money in circulation. This body could be a reconstituted Monetary Policy Committee of the Bank of England. These changes would provide a transition mechanism for the period during which the money supply was transformed from being nearly all bank debt-based to being entirely state-issued, debt-free. The length of transition could be quite long to allow adjustments to be worked out. This is, in essence, the proposal advocated in a much acclaimed book, The Grip of Death, by Michael Rowbottom, published in 1998. However, the threats of peak oil and climate change need urgent transformation of how the economy works, and so I favour an alternative. This alternative proposal has been worked out in a booklet called Creating New Money, a PDF of which will be found on the Money Myths website under Related Links, or by a Google search. It proposes that as from a set date, the banks would no longer be allowed to create new money. They would only be allowed to lend money that they currently hold in savings accounts or from their own capital, or borrowed by them from other sources, including the central bank, the Bank of England. When loans made before the changeover date are repaid to the banks, the principal of the loans is cancelled out of existence, as already happens now. This removes money from circulation. To maintain the total amount of money in circulation, new money would then be created by the central bank for the government to spend into circulation. All loans made after the date of the change would be from existing money, and so this money would not be cancelled out of existence when repaid. This is explained further in my booklet, Where is the Money to Come From?, which is available through the RSS feed or from the Money Myths website. From this time on, it would be entirely by government creation and spending into the economy that new money would enter circulation. This would give the government the opportunity to direct its spending where it is needed most, on renewable energy, organic farming, insulation of buildings and so on, as well as compensation to the real victims of the credit crunch, the general public, not the bank shareholders. Whichever method is adopted, the money the government creates would replace its borrowing requirement in its annual budget, and cut the interest burden this imposes on taxpayers. This borrowing requirement is currently funded by sale of interest-bearing bonds to banks and individuals. There are many important things to be paid for from the budget. One major expense is the buying back of the bonds as they mature. What happens at the present time is that they are replaced by the issuing and selling of more bonds. In other words, more borrowing. If instead they are bought back with new money of the government's own creation, it would steadily reduce the outstanding national debt, and so the heavy interest burden it carries. With this reform in place, as the outstanding loans are paid off, the money cancelled in this way will be replaced by government spending. As this money enters circulation without creating debt, eventually there will be enough debt-free money circulating. As much less debt will remain, there will be much less need to borrow. People will, in general, be much more prosperous. Ultimately, the government will have to stop creating any more money until or unless things changed in such a way that society came to need more. Alternatively, if the need dropped, some would have to be withdrawn and cancelled out of existence. Taxation would again become the main source of government revenue, but with greater prosperity it should be easily afforded. However, the nature of taxation should change for fairness and for ecological and social stability. This will be a subject of a later episode. As I noted already, along with the growing levels of debt, the current system of money creation causes several other problems, which I'll now discuss. First, a system that depends for its money supply on the willingness of individuals, governments or business to borrow doesn't ensure that the money supply is matched to society's needs. It results in a cycle of booms and busts, as already noted. When banks are confident that the economy is growing, they are happy to lend freely, until they get worried about the security of their loans. They then start calling them in and refusing further loans. This is happening now. This starts a vicious circle. Contraction of the money supply, causing business failures and unemployment, which then makes still less money available for purchases, causing more business failures, and so on. In the past, something eventually reversed this process. In the 1930s, it was massive government spending of money borrowed from banks for the New Deal in America and rearmament in Britain and Germany. With the less serious slumps since, lowering of interest rates has been used to make borrowing a more attractive idea. Now, with the unprecedented growth of debts, this solution can no longer work. Second, since banks can decide who they will lend to and for what purpose, they have enormous power over both the economy and society. Their decisions are based on their need for reliable repayment of the loans and interest, or the value of the collateral they can claim in the event of default. They don't worry about what is good for society. This makes lending for arms production much more attractive than for renewable energy, for example. Third, ever-growing levels of debt are the driving force for everlasting economic growth. It's the reason for the policy since World War II of planned obsolescence. The policy is to make goods that are deliberately short-lived. They're designed to fail or become old-fashioned, unrepairable, or need overpriced major parts. In this way, the economic growth could go on despite needs already being met. Otherwise, the money supply would collapse. In order to achieve this continued growth, manufacturers supply us with items that we don't need and make us want them through extensive advertising campaigns. This is grossly wasteful of resources, human and material, and gives rise to growing problems of disposal and pollution. Fourth, it is a major cause of warfare. In 1975, a top-secret US National Security Council document from 1950, NSC 68, was released and published in error. It revealed that the purpose of military expansion was to reverse the economic slide that began with the end of World War II. US GNP had declined by 20%, and unemployment had risen from 700,000 to 4.7 million. Its exports were inadequate to sustain the economy, and defence grants for the remilitarisation of Western Europe would generate exports into Europe. As NSC 68 put it, the United States and other free nations will, within a period of a few years at most, experience a decline in economic activity of serious proportions unless more positive governmental programs are developed. When, in 1950, the USA found itself with fast-rising unemployment, despite the effects of the Marshall Plan, boosting exports to Europe during the post-war period, the Truman administration secretly chose to promote the communist threat to justify its own escalation of military spending. Instead of expansion of the military, it could have spent more on domestic needs, health, education and infrastructure, etc. But this wouldn't have been politically acceptable. Increasing taxes to pay the interest on this government borrowing would not have been acceptable. However, when a population feels threatened, it will accept increased spending on the military and the resulting tax rises. Dependence on arms as export goods is a major factor in all modern wars. Now, the communist threat is replaced by the war on terror. So, fifth, the debt-based money system causes inflation. It raises the cost of everything. By increasing the supply of money, it directly causes this. Also, it has been estimated that, on average, almost half the price of everything is due to the hidden interest charges. Sixth, as well as drawing money from the producers of wealth to the pockets of the wealthy gamblers, the foreign exchange speculation market, based on bank-created credit, seriously distorts the exchange rates. This now involves over 20 times the amount of money used in the international trade in goods and services. This is part of the reason for the serious growth of third world debt. I'll look at this further in another episode. In the next episode, I'll be answering some of the questions that have been asked so far. There's still time to submit any questions you might have by visiting the website, where you'll find the email address on the contacts page. We'll not be producing a next episode until early 2009. Over the holiday period, I'll be putting out an extra episode that is a talk I recorded for the American Monetary Institute conference in 2007. Although it's not part of this series, I think you may find it interesting. But for now, I'll leave you with this quote. "There is nothing more difficult to execute, nor more dubious of success, nor more dangerous to administer, than to introduce a new order of things. For he who introduces it has all those who profit from the old order as his enemies, and he has only lukewarm allies in all those who might profit from the new. This lukewarmness partly stems from fear of their adversaries, and partly from the scepticism of men who do not truly believe in new things unless they've actually had personal experience of them." From Machiavelli, The Prince, 1532.